celebrating a pretty triumphant return to the bond markets this week.
Yes, indeed, Laura. For the first time in 4 years, Greece has sold bonds in international debt markets. The government raised €3 billion altogether, more than expected. On top of that, there was strong demand and the borrowing cost was lower than expected. In an address to the nation, Prime Minister Antonis Samaras said it marks a decisive step towards exiting the long-running crisis. Delano D'Souza has more.
The first bond sale in 4 years received considerable interest from international investors. Bond yields were at 4.95, well below the expected rate of 5.5%. In an era of low interest rates, investors are looking for high returns.
The five-year bond issue succeeded beyond expectations. This means that the international markets, as of now, express their undisputed confidence to the country's economy, to the country's future, because they invest in this future.
Greece was the first country in the Eurozone to accept a bailout and has so far borrowed €237 billion. The country's debt stands at 175% of its GDP, and while it's currently been given junk status by mainstream ratings agencies, the idea of Greece standing on its own 2 feet after 2016 has begun to look possible. However, experts are warning against complacency.
We have to remain very vigilant permanently. This is no time for complacency, but it is a symbolic illustration of the fact that the Europeans have preserved their own historical construction.
Greece's return to the bond markets illustrate its tough austerity measures appear to be working, although its real economy continues to suffer. Unemployment data released on Thursday dropped to its lowest level in 11 months, yet remained high at 27%. Meanwhile, anti-bailout groups are preparing rallies on Friday during German Chancellor Angela Merkel's official visit. She's seen as the main backer of harsh austerity measures imposed on Greece.
Now you saw a snippet there from an interview with Jean-Claude Trichet, the former head of the ECB, and you can see that interview in its entirety here on France 24 on Friday. Now, the Greek bond sale has also been welcomed by the head of the International Monetary Fund. Speaking at a press conference in Washington, D.C., Christine Lagarde said the sale was a step in the right direction for Greece. Lagarde also spoke about the plan to grant Ukraine emergency loans to the tune of $14 to $18 billion. Ukraine is running out of cash and its foreign currency reserves are low. Lagarde said that the board of the IMF looks set to approve of the loans soon. Let's listen in.
The board has met several times in an informal standing, and we hope, provided that the authorities deliver on their commitment, which we have every reason to believe they will, we hope to review that program and submit it to the board at the end of April or in the very early days of May.
Some hope there for Ukraine. We're going to move on now to a new batch of trade figures from China, which is sparking fresh concerns about the world's second biggest economy. Imports to China dropped by more than 11% in March in comparison to the same month last year. At the same time, exports from China fell by almost 7%. It was the second month in a row that exports fell. Both figures are highlighting concerns that China is heading for an economic slowdown and potentially job losses. Now, that weaker than expected data from China is doing very little for the mood on Wall Street this session. Let's take a look at the latest stock market figures from the United States. The focus is very much on technology shares and on concerns that earnings from technology companies won't be able to live up to expectations. Let's see if we can bring in those figures. There we go. The Nasdaq, their tech-heavy index, is taking a real hit. As I said, we are seeing these concerns about tech shares, and the Nasdaq is down 2.9% this hour. The Dow Jones and the S&P 500 also in negative territory. The Dow Jones down by almost 1.3%. Despite the successful Greek bond sale, we also saw European stock markets closing to the downside, with the FTSE in London bucking the trend as the Bank of England kept its benchmark interest rate steady at a record low. Let's take a look at a few other stories that we're keeping an eye on for you. Shares in Marks & Spencer's slumped 3% during trading on Thursday. Concerns about profit margins were seen to be creeping in towards the end of the session. It came even as the retailer posted rising sales in the quarter that ended on the 29th of March. Food sales did well as usual, and rising clothes sales also sparked hopes that a turnaround plan is helping M&S. But as I say, shares, they were still down 3% at the close. Meanwhile, drug maker Roche came into the spotlight on Thursday. A French competition watchdog said it's raided the French offices of Roche and its rival Novartis. The watchdog was acting on allegations that the two had been fixing the price of an eye treatment. Separately, researchers have also said that Roche's best-selling flu drug Tamiflu had few beneficial effects. And another story that we're watching for you, the mobile network operator Vodafone is upping its exposure to the Indian market. The UK-based company is taking full ownership of its Indian unit by buying an 11% stake from a minority partner. The value of the transaction is 89 billion rupees, or around €1 billion. The deal follows a rule change that allowed foreign carriers to take full control of their Indian mobile businesses. And that sale will apparently have gone through on Friday. So this is a moving story. Back to you, Laura, for now.
Marcus, thank you very much indeed. Marcus will be back with another business update later in the programme. But now time to find out what's got people clicking, sharing and liking over the past 24 hours. It's time for Web News.